Hello everyone, welcome to this webinar. My name is Kamal Manocha. I represent PMS AIF World platform that has been started 4 years ago to address real investor questions and to create real wealth creation stories for our clients and investors. Today we have a very simple and very significant topic to be discussed, which is importance of valuations while investing. We have been talking a lot about valuations in almost every webinar, and almost every fund manager has been supporting that valuations do matter. But over last, I would say, 5 years, we have also seen growth investing done without worrying about valuations has also worked quite well. Obviously, times do change, and growth investing done in quality businesses without focusing on valuations does work, but expectations need to be kept accordingly. So we will cover everything about valuations, its importance, and how ultimately to assess a company while investing, because there are various types of businesses. Many new age businesses have seen obnoxious valuations and still they have made money, and many, I would say, old economy businesses like PSUs have very low valuations and still they have not worked. We have Mr. Siddharth Oberoi, who brings with him 27 years of experience, and he's created a very brilliant presentation to discuss this particular topic on what is the importance of valuations and how to assess the valuation of a stock while investing. He brings with him, as I said, very pertinent experience of managing public money. He's founder and CIO of Prudent Equity, and he has been managing money, for public and giving very stellar return. We cannot talk about a return particularly, as a number, because we are not wanting to talk particularly about any product here. This is a learning focused webinar. And without taking much time, I hand over to you, Siddharth. In the first half, you can cover your presentation on the topic, and then in the second half, we'll take questions and answers. Over to you, Siddharth.
Thank you, Kamal, for the introduction. It's a wonderful platform that you've set up to enable everyone to know the investment manager's investment philosophy. So shall we start the presentation?
Absolutely. Go ahead.
Can you see the slide?
Yes, absolutely. Go ahead.
All right. So before we start the topic, let me just introduce you who we are, where we come from. Prudent Equity was started as a stock advisory firm in 2012. Thereafter, in 2015, SEBI introduced licensing. We applied for research analyst license. Over the last 11 years, nearly every client that joined us through word of mouth without any marketing push. In 2017-18, we started getting offers from family offices to assist them. Last year in 2022, we launched our Category 3 AIF, a long-only fund. Yeah, so before we begin, let me just take you through our investment philosophy and the investment criteria, because the topic that we are discussing is, intertwined with the philosophy itself. We are very bottom-up investors in the sense that we do look at macros, but not very minutely. We are very focused on what the individual company is doing. Within that, we have certain criteria. The paramount criteria is growth. We look at companies that can grow their earnings over the foreseeable future by, let's say, 15, 20, 25%. Now, this growth is not a very generalized growth like GDP will grow and per capita income will grow. We need specifics here, why this company within this industry would grow. We would like to enumerate, have some identifiable, some predictable source for us to ensure that this growth will continue in the next, let's say, 3 to 5 years. So this growth has to be very visible and predictable. So that is one criteria. The second is that we look at corporate governance very carefully. We look at companies that have displayed growth in various business cycles. We see that the management has treated the minority at par. We also see how the capital allocation has been over the last few years. These are some of the parameters we look for to gauge the management and the corporate governance in the company. We also look at the capital structure. We look at how the balance sheet is structured. How has this growth been financed? We usually avoid companies which are highly levered. We also look at other parameters within the P&L and the balance sheet to see if it satisfies our criteria. The last is the margin of safety. This is a very a common trait which Benjamin Graham and Warren Buffett has been espousing. But as we go forward, I'll explain you, what is an intrinsic value and what is the need to buy it at a discount to it. So these are the little broad criteria. This is there was a very famous quote from James Carville, who was a strategist for Bill Clinton in the 1992 elections. He said, "It's the economy, stupid." In the investment parlance, we are taking it at, "Is the valuation stupid?" Basically, it derives from the point that all returns are determined by the price you pay for a stock. So valuation is very important. I will explain you the concept of intrinsic value and why do we want to buy it at a discount. Why not just pay a full price for a security? The concept of intrinsic value is that whenever you're buying an asset, you want to know what it is valued at. Without that, you're groping in the dark. For example, let me give you an analogy of the real estate sector. Let us say you're going to buy an apartment. How would you value that apartment? Let us say, for theoretical purposes, the apartment is for 1 crore rupees. You would look at, how's the quality of construction. You would look at, maybe the complex where it is made. What are the facilities? You would look at nearby areas, whether there is a departmental store, a hospital, hotel, whatever. So you would judge by the address. You would also see what recent property deals have taken place. So which means you're looking at peer group valuation. So, but you need to identify some value to say that, if this apartment is 1 crore, I'm buying worth 1 crore. And maybe over a period of my holding, this is all assuming that we are not buying this property for residential, we're buying as an investor. So as an investor, one would assume that you would hold this apartment for the next maybe 5 years, and this 1 crore would become 2 crore. So you would do a good CAGR. But what happens if your thesis does not pan out according to what you had thought? So therefore, the concept of buying it at a discount. Now, what happens in the real estate market is that apartments or properties don't, they sell cheap. But in the equity market, which is the auction market, this happens very regularly. An apartment cannot be selling for 75 lakh, 80 lakh all the time. But in the stock market, stock which may be valued at 100 can even sell for 50. And then that is the reason why you can take an advantage of such an anomaly. So unless you know what this company is valued, how would you buy it at a discount? Discount to what? You can look at how the peer group is trading. Let us say there are 10 stocks in an industry. You could look at that all of them are trading at a X multiple and this stock is trading low. But the flaw in that is that maybe the entire sector is overvalued and you're misjudging the whole thing. You would look at maybe a company is growing at 30% per annum and its P ratio is just 20, and you can say it is cheap compared to its growth rate. But again, that is a very vague parameter. So in order to ensure that you don't buy at a wrong valuation, you first need to value that asset. You need to value that company. Now, what are the things you would require to value a company? You would look at the economics of the business. You would look at the management. You would look at per cost unit. You would look at the industry dynamics. What this company, how this company compares within the industry. You look at maybe the balance sheet. You put some certain things from the balance sheet. Now, intrinsic value is not a defined, you can say, a number. It will be a range always. For example, I may come out with a valuation of 500 for a company, and Kamal, you might come out with 500, and someone in the audience may come out with 450. But at least we know that this is the range the company is should be valued at. It cannot be 2,000 or it cannot be 100, which means one of us or all of us are valuing it incorrectly. So first is you determine the value of the company, and then you buy it at a discount. Now, but why buy at a discount? Why not just, if you have figured out that the value is 500 and we know that the earnings are going to grow, why not just buy it at that and just hold on? We do that discounting because, for various reasons. For example, maybe we have erred on the side of calculation, and later on we come to know that we did a mistake in the calculation. To protect ourselves from that, to have some kind of cushion, we would want to buy it at a discount to whatever value we had come out for this company. Other reasons could be, that maybe we bought correctly, but over the period of our holding, let us say in the next 5 years, the fundamentals change, and that renders this value lower. We don't have any insurance for that because we already bought it at a stiff premium or absolutely at the value. So to have some kind of a risk reward in our favor, this is important. A third reason could be that we, at the end of the day, we are all armchair investors. We don't have capital allocation control of these companies, and any management indiscretion would lead to the valuation coming down. To protect that also, and to protect our capital, we would want a certain discount to whatever we have valued the company at. So this is a broad concept of why an investor needs to first value an asset or the stock, and then the reasons I've given you why it should be bought at a discount in order to protect the capital. So let me just take you through the next slide. I'd like to just disclose here that these slides are not to showcase any investment prowess of ours or to highlight any returns. These are just for educational purposes. But these are all stocks that we are going to discuss. We've actually bought, sold in the past, recommended. And we didn't want you to backtest any random data from the past to prove a point. So these are live examples, but let's take it for educational purposes. So there's this company called Alkyl Amines. It had a market cap of 500 crores at the time we covered it. Had a profit of 45 crores. Now, if you remember the first slide, I showed you that how growth is important. Growth is the primary ingredient. So one has to identify that growth parameter within the company. Here, the company was expanding its capacity of a product called acetonitrile from 4,200 to 6,000 to 10,000 in phases. It was also setting up a plant in Dahej for specialty chemical derivatives. Now, anyone could have figured out that if this plant were to set up and this company would have expanded this capacity, what the numbers would look like, and one would have come out with a broad that it would probably see a tripling or a quadrupling of profits. Now we come to the valuation part. As you can see from the slide, the P ratio, forward P ratio was about 5, 6. Now other parameters remaining the same, which means good management, a very well-run company, etc. We figured out that there was a lot of runway ahead for growth. and the stock was not justifying the valuation. Again, one has to value the company. Your valuation can be very different than mine, but if both of us conclude that 5 years from now or 3 years from now, the profits would explode on the upside, you would figure out that this is a very cheap price. What happened was that the stock went up 5 times thereafter. Now, this is very interesting. The earnings went from 45 to 200 crores, but then did not grow further. Over the last 3 years, earnings have not grown meaningfully. But what has happened is that the stock price has gone up by even 5x further, after, when we sold it off. Because the market was extrapolating whatever had happened in the past into the future. So, we are in the business of buying a mispriced bet on the downside. We bought the mispriced bet. I mean, anyone could have bought Alkyl at that price, held on to the stock, made the money, and see the pendulum swing the other way to the extreme. Now, again, what will help you is the valuation of the company. You would figure out that Alkyl was at X price. Maybe you were wrong, and you would probably bid 10-15% higher to that, and you would. But what happened was that the pendulum swings, and it just went on and on and on. In the last 3 years, the stock has given no returns because the earnings did not grow the way it had in the past. The basic reason, again, if somebody would have studied the company, would have figured out that there was a product called acetonitrile, just like crude. It was traded on the market. You could have figured out what it was trading. It was trading, I think, 180 rupees per kg or something. When we had covered this, it went to 300, which was an unsustainable level. The profits went up, both because of expansion and the pricing going up. What happened thereafter? The price of acetonitrile came back and other product prices came back. The stock kept on going up, ignoring this part of the business fundamental. And the result is last 3 years, there were hardly any returns. So again, what we see here is identifiable, predictable growth going forward, and the valuation being very cheap. So look at the next slide. Now, in this company, there was no expansion. So how does somebody take out the valuation? In the first example, it was pretty easy. You could have seen how the capacity was growing, so you could have made a capex play. But in this case, there was no visible capex. Now you had to look at certain soft points, what the company was doing at that time. The company had just changed its business profile and was entering all high margin products, basically into technical textiles. The management was buying its own stock. The company did a buyback. They had set up a dividend policy where they would substantially increase the dividends. They had planned to prepay all the debt in the next 18 months. The interest cost itself would have saved a lot of money. So you would have seen that the quality of this company was changing from a ROCE of 12%. If you just jot down the numbers, you would have seen, it would have gone to 25%. Now, a company which had an earning trajectory like this, the quality of its profile was changing, was trading at, as you can see in this, on the slide, was trading between 5 to 6 times. Again, it's not the P ratio, it's the valuation. The valuation showed us that the company was priced at X. We probably put a 50% discount to it. During our holding period, that value kept on increasing. And eventually, the stock moved up. Garbari was 4X. Again, the pendulum swung on the upside. The swung on the upside, it went up by another 5X. Again, the earnings did not compound at the same rate. Market was extrapolating that it would continue this same growth in the future. This rise from our buy price to the intrinsic value is what in the market parlance, what market participant called earnings re-rating. So for us, it is not re-rating. It's actually no re-rating going on. It's the intrinsic value expanding and the stock is catching up to it. So let me take you to the third slide. Now, all these three companies are chosen in different time formats. They're chosen for different valuation parameters. In this, as you can see, there is no P ratio mentioned because there is another method to play this is called migration path, which legendary investor Chandrakant Sampath introduced. So what he says that was that there are some companies where you cannot pinpoint a value because there are the earnings cushion is not there. So what you do is you look at the potential growth going forward, and you see what the market cap today is. If you look at the slide, the market cap in 2014 was 4,400 crores. The company was developing 50 projects in 12 cities. So what happened during that time was that there was a lot of disenchantment with real estate developers because a lot of these developers had left projects midway in Delhi NCR and other places, and buyers were scurrying, for cover. So then there came a shift where investors wanted to go with groups which are well funded, which have reputation, and there came in the Godrej Group. Another factor was that you remember I had discussed about predictable earnings. Godrej Group had 3,500 acres of land at Vikhroli. They had just tied up with the Godrej Properties to develop this land over the period of next 10 years. So there was an assured growth or assured land bank which they didn't have to buy. So these were the parameters that one could have looked. We looked at these. We found that, as you can see on the chart, left side, profits expanded. But now again, what happened was that here is the prime example of why valuation matters and why you should buy at a cheap price. You remember the cushion or the insurance we talked about earlier? As you can see in the chart, the profits from 2017 till now have not grown. Now, while buying, we had extrapolated that profits would just shoot up on the upside, but it didn't happen. So even if we were wrong, we still made 2x. In fact, the stock went up 5x further from there. It got mispriced on the upside. The result, hardly any profit growth in the last 6 years. But because the buying price was so cheap, margin of safety was adhered to. We were able to come out with a very good return. So there are three different companies where we've seen that there were growth going forward, and there was a lot of valuation comfort. Now let me take you through the next slide. Now what happens that someone is not able to take out the intrinsic value, doesn't have the time or doesn't have the wherewithal to take out the intrinsic value of all stocks, or maybe even whatever is in the circle of competence, even then they find it difficult. What happens then? So there is another way to play the investment game, is that you buy very well-known stocks. Look at the presentation here. We have covered 3 stocks: Asian Paints, Nestle, Page Industries. Very strong brands. These companies have entrenched market shares. They have grown in all kinds of business cycles. Very good corporate governance. So this is the and all are consumer facing, bluest of the blue chips. Now I've taken the data from FY19 because FY20 was the COVID year and we wanted to have a bump on that year. So we've just taken a normalized earnings. As you can see, the earnings grew at 15% CAGR, but its stock price grew at 17. Nestle grew at 10%. Stock price grew at 13. Page Industries grew at 30. Stock price 10. So if you do a collection of 10 of these stocks, you would find that they have grown at 14% on an average, which is what their profits grew at. So the stock price is basically emulating the profit growth because there are very less earning surprises here. There are very less chance of a P re-rating, as they say, or the intrinsic value is probably well discovered. Just to give you an idea, during this time, the index did 11%. So by buying these stocks, you had a 3% edge over the index. But let us say if you're in you have given money to a fund manager and that fund manager takes 2% or whatever, that edge has also gone away. Now you just have 1-2% edge over the index. So if you're happy playing a little this gap, then these stocks are very good. But 1-2% over the index over a very long periods of time is also very good returns. So this is not to say that a collection of these companies give bad returns, but then we have to call a spade and see that they are not going to give us a 20% or a 25% CAGR, because and also on the risk side, there is no place for an earning disappointment. There is no place for a derating because they're all almost priced to perfection. So one can even play this kind of investment style if that suits. But we are not in that game, because for us, beating the index by a substantial margin is what the mandate is, and we would like to do that. So again, this is a collection of 18-20 stocks that we have randomly picked. Again, no general backtesting. These are all stocks bought, sold, recommended at some time in the last 11 years on our service. As you can see, they're all from different market caps. Now, the P ratio looks very low, but once again, P ratio was not looked at while buying these stocks. One should not look at P ratio per se. I've given an example of Godrej Properties before. Just to give you the context, Godrej was trading at a P of 30 at that time when we had bought this. So you see, in all the instances that you can see on the screen, one could have seen a very predictable, visible growth going forward. We would have seen that by a little bit of calculation, we would have seen that the value is X and value 3 years, 5 years from there would be Y. And we would have seen that they are all trading at a very, very cheap prices. Now, it could be that the valuation metrics that we follow usually is very conservative, and therefore the discounting comes to be very cheap. But broadly, all these stocks were trading at a very cheap levels at the time when they were bought. So one can do their own calculation of intrinsic value and find that no matter how you slice the dice, they were all cheap at those times. And as they say that there is a bull market going on in every bear market and a bear market in every bull market, out of these 6,000 listed stocks, there's somewhere a section is trading cheap, and as an investor, one has to go to those sections. Now I'll just take you to a few two case studies. This shows why valuation is so important. You can be right, you can make money, yet because of external factors, you can, the thesis can go wrong. This was a company that we had bought called Hinduja Global Solutions. We picked this up on 23rd March 2020, right at the bottom, but that was just a coincidence. Bottom cannot be found this way. So what happened? We figured out that the growth trajectory was very visible. During our holding period, there was a news that the company was to sell its most profitable US business to a private equity group for something like $1 billion. In the subsequent con calls, we participated and we asked the management, and they said that they're going to distribute the windfall with the minority shareholders. We believed, and we kept on holding. The stock kept on going up. We had, I think, 6 times on this. Now, here is an example of why you should exit, even when there is a lot of money left on the table. When the deal concluded, the company gave a meager 300 crores as dividend. Thousands of crores were being taken out from the company to the promoter's associate group company, lend for 8% interest. We thought that the minority was getting shortchanged. This was bad corporate governance. We sold the stock immediately. The stock is down 50%. Very cash-rich company, but we don't want to hold it. Any point of time, an investor sees corporate misgovernance, all bets are off, and money should be taken off the table. Later on, the company did a lot of other bad things, which made the stock price kept on going down. I'll give you another example here. So this was a company called Omkar Specialty. This case study would also show you why buying cheap is more important. In our earlier discussion, I had told you that what happens if your thesis does not pan out, or over your holding period something happens that renders that value lower. What will you do? What is your protection? So this company was bought at a very cheap price, at the price we thought was cheap. The company again had very visible earnings, but what happened was that management was not walking the talk. Each time they would come out with some statement which never matched the actions. They kept on pledging their shares. At one point of time, 71% of the company's shareholding was pledged. They kept on pledging, repledging, and we found certain negatives in the balance sheet. We thought that 1 + 1 is not matching to 2, and we exited on time. The stock went down 90%. But because we bought at a very cheap rate, a very cheap price to what we thought was the intrinsic value, we were able to protect the capital and exit on time. Had we, let us say, thought the value of this company is 300 and bought it at 300 and something negative would have come out, there was a surety of capital loss, permanent capital loss, and which anyone could have avoided if one is focused on value and the price and other points in the corporate governance. Okay, so I'll just before I've just explained you the valuation part of it, but before we end, I just like to tell you why we are different and how in our theory of valuation why certain things are included and why excluded. So this will give you a certain idea of about another style of investing that is being practiced. You would have heard that hold stocks for long term. Everyone says that, which we also believe. But for us, long term is a series of several short terms. Now, short term doesn't mean 1 day, 1 month. It is 2 to 3 years or maybe 5 years in the cycle of a company. That is the reference of short term here. So what we do is we analyze the company. We see that there is a huge earnings expansion forward. We see that the stock price is cheap. We ride that trend. But when we think that for the next few years, the earnings are going to plateau and the stock price has exceeded its intrinsic value or has gone into the other extreme, we are happy to take off our capital and take it to some other place where it will repeat the performance. You may have noticed, or let me just point this out, that there were times when companies like ITC didn't do anything. The stock didn't do anything for 10 years. There were times when HUL didn't do anything for 10 years. There were times when Infosys or Reliance, they were all stagnant for a decade period. What had happened was that the earnings were growing, but the stock price had gone up so high that there was no valuation comfort. So for us, multiplying the capital is more important than the stock. In hindsight, you can say, this stock is up from X to Y in 20 years. But within that 20 years, we are happy to play that cycle, exit the capital, move into another stock, repeat the performance, and so on and so forth. Now, how do we do that? Is that we have a proprietary method to calculate the intrinsic value. There is no specialty in it. You can do it. Anyone can do it. You just have to be at it. Your valuation number may not be perfect, but even ours is not perfect. It's always a range. But once you have identified the value, and then you need to buy it at a discount, and this is how we do it all the time. We value all the companies. If a company is we're not able to value it, we probably just drop that company and move on to another one. So this is just a brief of what we did in the last decade. We were able to kind of get most of the stocks at very good prices. We were the first one in 2013-14 to go for chemical stocks. We saw that not only the industry, all the companies within the industry were expected to do well. So I think 13 to 15 stocks went in during this time. But just to brief the whole thing, over the last 11 years, we had a success ratio of about 85-90% over 5 services. So that concludes my presentation. Over to you, Kamal, for any questions.
Sure, Siddharth. I think this presentation has been very insightful. I was reading all the comments. There have been mixed, I would say, response from the audience in terms of their conviction with regards to your presentation, because I think most of the audience has been holding some of the high value stocks, because many have invested in stocks like Nestle, Pidilite, Asian Paints. Now, let us take some of the practical, I would say, aspects. If an investor has entered into a stock like, for example, Asian Paints at a 90p, today the stock is at 75p. In the current context, if you are, in investor's place, what would you do? Would you average that stock at these levels, or is there any other strategy that investors should follow?
If I've already bought in and there is no other choice, I wouldn't average again, because the concept is that if you thought if somebody had entered Asian Paints at 90p, he thought that in our example, he thought that earnings would compound at certain rate, and he would get that compounding in the stock price. Again, it depends on person to person. I wouldn't have paid, because I wouldn't have taken out the valuation Paints at such an elevated level. But having said that, we need to understand that these stocks, these companies are seldom priced cheaply. You will not get an aberration where, except for maybe Nestle during its Maggie controversy, these stocks cannot be, bought at, abysmally cheap levels. So some overpricing is assumed, and one could have just, if somebody bought it at that price, I mean, you can just keep on holding it. You have no choice right now. Because I assume that you're a long-term holder and you would just continue to hold for the next 5 years, and I'm sure your capital may be recovered, because as you saw in on the presentation, the earnings would emulate the returns would emulate the earnings.
Right. So where do you see there is more attractive valuation in the entire spectrum of investable universe, from large, mid to small companies?
So everywhere. Any time we see a mispricing, any company that we are able to value, not accurately, but somewhat, we're happy. So there was a time we played even ITC at about 175, 200. So everything has a price, and when large caps become cheap, they are the best investment, because these are very well established companies with very good managements, and you seldom get them cheap. And when you do that, that's the time you load up. But other than that, we are in mid and small caps, where we put a little bit of diversification to ensure capital protection.
So do you currently see large caps at that attractive valuation?
Not really, but slowly they're getting there.
Sure. So what are your views?
Yeah.
So what are your...
Yeah.
Okay. Oh, please complete your answer.
No, assuming they keep falling. So that was...
Sure. So what are your views with regards to some of the new economy businesses, like e-commerce businesses, or I would say stocks like Zomato, stocks like Nika, and many others, which have been kind of like at one point of time, stocks like Avenue Supermart, Dixon Industries, Dixon Technologies, they were available at 100 plus P. And even at those levels, some of those fund managers used to say that obviously these stocks are new age businesses, and hence old school of thought, which is like valuation conscious style of investing, cannot be applied on them. Again, at present also these stocks are not obviously, very cheap, but they're still expensive, but they have fallen almost 50% from their peak. So what are your views,
Yeah, so there are two things here. One is that new age businesses, and one businesses where there's profit growth, like Avenue Supermart. So let's take the businesses which have new age businesses, which like Zomato, whatever, listed. Firstly, they shouldn't have listed in the first place. You are sharing your losses with the public. Um, and for the last 7 years, I've seen that the public is gullible, and they can be marketed, and which is what many investment bankers did. But losses shouldn't have been socialized in this way, the way it happened. Uh, I would say till the time any company is ready to be in profits, they should not come out in the market, because forget valuation. A lot of people in the market don't even know the price or value of anything, and all they know is a brand that they have used, and they think that because everyone is talking about it, that is the production they will have, and the brand will save them. But I think these companies, there's a lot of disservice to investors by coming out on public platform and raising money through small shareholders. Coming to companies like Avenue Supermart, etc., they are at least profitable and growing with a huge runway for further growth, because these industries are not fully the growth is not fully captured in them. But again, like I told you, that if you have bought one at such an expensive price, getting out is not an option right now. You'll have to wait out for your 5-6 years. I'm sure you would have bought it for long term. But if somebody tweaks their concept from buy at any price to saying that let me try as an investor to value this company, or the fund managers, that's the job of the fund manager, to value the company. And if the fund manager can say, I'm not ever going to get a discount of 50% in such a great business, so okay, you can get a 10% discount. But then you need to ask the fund managers, what value did you accord to these companies? When you're buying, let's say, Asian Paints, what according to you is the right price of the stock? Is it 5,000 and therefore you're buying at 3,000? Is it 3,000 because you're saying, I will never get it cheap, I'll buy it at 3,000, and I will and the earnings will ensure that I'm 15-20% growing in my CAGR. So that answer everyone has to do. What value you accord to that company, and if there is no discounting, then you need to at least come out with an answer that I think 3,000 is the value. Otherwise, if you say 1,500 is the value of Asian Paints and I'm buying at 3,000, then you're stumping yourself. You're saying, of course, I've double paid for it, and it'll take many years to catch up. So that answer everyone has to do. I haven't taken out the valuations of these companies, but those who have, those questions must be asked to those. What is the value you accord to these companies, and I think that will answer it.
Sure. So at what value will you buy Asian Paints?
So I don't know. I think I'll wait for some kind of a substantial fall. I don't know. I'll have to value it, but at 70-80p, nothing is on my horizon. Nothing. I mean, just about nothing. The last time we saw these kind of earnings growth was in the 90s, where every year the IT sector companies was to show 100% growth rate. And then you had to, I remember from 1996 to 2000, there were maybe 50 companies that were doubling and tripling their profits every year. And again, the pendulum swing on the other side. So if somebody thinks that, if I think that Asian Paints can compound its earnings at 25% per annum for the next 5 years, I don't know, I would probably pay a premium to it, maybe buy it at 35 times and say, at least I have the comfort of going into the best company. But 80, I cannot justify myself. I cannot justify anyone. So.
Sure. Right. So while you pick your stocks and do your investments, do you also think about the macros or sector approach, or you're only purely focused on picking businesses across sectors, irrespective of the macro scenario? You're just looking for right valuations.
Yeah, absolutely. Because there is no way anyone can predict the macros. Uh, you know, who knew that 6 months before that the interest rates would have risen so high as they have done? So the best protection is that you value a company and you buy it at cheap. Make sure it is cheap, or at least it is reasonable if you're going into a company which you think is very strong. Uh, Macros, we think only when a major event takes place, but broadly we kind of try to ignore the macros. It's not that we don't look at macros, we look at, but there is no way you can predict what may happen 6 months down the line. So if you're timing the market according to the macros, nobody will get it.
Sure. See, when think of value conscious investing, the doubt always that comes to my mind, I want you to address that doubt, is that, value of a business is known to us based on its trailing numbers. Growth of that business is not known to us. And if value of that stock or business is low, it is because the majority investors are perceiving growth to be relatively uncertain or less kind of in comparison to its peers. Now in such a scenario, when we focus only purely on value and are trying to take chance on growth, how is it that you will remain so confident and you can ignore the macro environment? So how will you balance this, and how will you kind of build a portfolio in such an uncertainty while focusing only on value and hoping for growth?
Hope is not an investment strategy. We cannot hope for growth. We need to see specifically what this company is doing. Like I had explained you in examples, I can give you many. Uh, in my context, what happens is that this concept of GDP will grow, per capita income of this product in China is this, so we will match up, is good for theory, and even to take it at the back of our mind that there is a lot of growth there. But within that, we need to know what this company is doing. What is it doing different? How can it capture market share? How and where the growth is coming from in this company? What is the management doing different that it can do a 15, 20, 25% growth going forward? We are looking for identifiable factors within the company. And if there are none, then so be it. Then you move on to another company. But we need to, at least that's our investment style, because we need to first ensure that the value that we are calling will grow. If the value is not going to grow, then there's no point of buying it cheap, because anything that does not grow then degrows eventually. So we need to figure out where the growth is coming from. How is this company going to grow? Not in terms of hope, but in terms of after studying the company, what are the factors that would lead this particular company? What is it doing different that will ensure that growth is there? And then we start to value the company, and then you seek protection, and then you buy at a discount.
Sure. So at present, when the trailing P of Nifty 50 is around 20 and forward P could be, say, 17, you're projecting 1 year of growth. Are you comfortable at these levels, or you feel that these are also kind of expensive levels?
Firstly, we are not buying the index. We are trying to beat it. So we are ensuring that, let's say the earnings of this Nifty 50 is going to grow at, let's say, 12% for the next 3 years. Maybe it was to grow at 15%, but because of a little slowdown, because of high interest rates, the earnings from 15 has come down to 12%. Right? We need to, then if 12% is, we are satisfied, then we just buy the index. But we don't want to buy the index, we want to beat it substantially. So we want to buy companies which we think are mispriced. So it's a nuts and bolts kind of investing, where you go into a company, look into what it is doing, and we figure out that no, this company is going to grow at 20%. Nifty is growing, Nifty aggregate earnings growing at 12, this company is growing at 20. But Nifty has the best of the companies. Is this company good enough to be bet on? Are there corporate governance issues? Because mid and small companies usually topple in bad economic environments. So we need to see what this company, how is this company placed. So very company specific, where if we are able to see that the company's growth is assured, uh, and we can somewhat, put a finger to it. Let's say 20% growth is quite in the bag given for the next 3 years. Then we come to the valuation. So uh, generally looking at the Nifty, one cannot make a portfolio of stocks. That's my thought.
So, in your investment approach, while you will be focused on business in terms of its expected growth and drivers of that growth and valuation at which it is available, I'm sure you will give some significance to diversification in the portfolio across sectors. So, if today you have to, do that in the current context, how will you select, what three, four, five sectors you want to add in your portfolio, or you will
Yeah,
purely
look
go
at
by
so if
structure?
you're going for sector selection, I would probably go for infrastructure, where I think uh, during the last 1 year and going forward, there's going to be a lot of order bagging, a lot of projects, as you've seen over the last several years, that during election times, all these projects are handed over. So one cushion is that we know that these companies have multi-year order books on hand. um, I'm just giving a backhand calculations of sectors. Uh, Railway sector, again, billions of dollars of orders have been placed recently. Companies that have bagged those, those are the companies we can bet on, because we know that at least, even if the economy were to go down, because they have these orders in hand, there is an assured growth going forward. Again, within that, we have to see that how these orders were bagged, whether they have escalation clauses built into them or not, and other things. Other than that, banking, I would go. You would have seen that bank growth has been pretty good over the last 1 year. Most of the banks loan growth has been 15 to 20%. Uh, During COVID time, a lot of banks did provisioning, excess provisioning. They're coming back with a lot of recovery of the NPS. So there's a few of the sectors I will see where I can see that there is an assured growth in the foreseeable future, and within that, I will try to see the companies that I can bet on.
Sure. So while you have been managing public money in AIF, what is it that kind of you want to talk particularly about this product structure? Because AIF as a product structure is new to many HNIs. We have been doing a lot of, I would say, talks with various fund managers, and I have always tried to talk particularly about this product structure. Also, how is this different from mutual fund or PMS, and who are the investors who should be ultimately investing in this structure, and what are the various, I would say, uh, perspectives that investors need to be aware of before going for an AIF kind of a structure.
So AIF is a like an offshoot of a mutual fund only, except that the ticket size mandated by SEBI is a crore minimum. The best part of the AIF is that it's a pooled in money. So unlike a PMS where there are different accounts, fund managers probably have to look at 100 different accounts. Maybe a client has come in recently, a client has redeemed, added money. So you have to factor in all those points in the portfolio. In the AIF, it's operationally very easy that any new money coming in gets divided into everyone's capital. For example, let us say you have put in an amount of 100 rupees, and stock, there's a crash in the market and the stocks are down, and somebody puts in 100 rupees. That will, because it's a pooled in money, the money goes into the fund, and um, the fund may be able to buy it at a cheaper rate. So I think there are many advantages of the AIF. Another one advantage between the mutual fund and this is that in mutual fund, most of the mutual fund are run by AMCs, where the fund manager keeps on shifting jobs based on promotion. So every 3 years, you see a fund manager shifts. In the AIF, that seldom happens. If you know the fund manager's strategy, you would know that this will play out in all market scenarios, and there is no surprise element in that.
So while selecting an AIF product, investors would have choice of going with large institutions like Kotak, ICICI, Sundaram, which are backed by mutual funds, a large research team, or boutique fund houses like yours, or few others which are actually quite popular, which could be like Sage One, Samiksha, right, which have been doing well. There are pros and cons of going with either institution or kind of founder-driven companies. How will you answer this question from the point of view of what are the factors that investors need to keep in mind while selecting between these two type of setups?
So there is just one criteria. I mean, I as an investor would look at, as somebody recently said, in investment, everything is performance. The rest is talk, and talk is cheap. So I would just look at performance, and I would just bet on somebody who has, done well in all cycles.
What according to you has actually worked quite well for you or has given you conducive uh, structure that you have actually been able to deliver so stellar returns? Again, I'm saying you're not giving any number, but in your I think presentation somewhere you quoted the returns that you have been giving. So what is it that worked over years in your favor? And I'm sure you would continue with that, but I'm sure one knows one's area of strength. So we want to understand what's your area of strength which has worked for you.
So I think one is to identify companies which are trading cheap. One is that, but that is a given. Another thing I'd like to point out here is that playing with cash. So a lot of fund managers, what I have noticed is that they, whenever the money comes in, they immediately invest the money in their favorite stocks. That's the 10 best or whatever. In my case, I like to keep cash till I get the opportunity. I'm ready to wait and wait, but I'm not going to put the money where the valuation comfort is not there. Um, at the end of the day, we are all armchair investors. We may be wrong. We need to cushion against that pitfall, and so we need to be very sure that cash will move in only when uh, the discrepancy between our value and the price is justified. So cash play is very important. I keep a lot of cash. Even now, when we started the AI, we're still 70-75% in cash, going in very slowly. Valuation comfort is not there even now. So we are going in very, very slowly. I don't want to exhaust the cash. I want to keep it at a time when, when the market bottoms out. I mean, you cannot time that, but when my list of stocks bottom out, where I think that this is these are very good rates to buy. So cash is one way, to play. And sometimes when the market is overvalued, I sell out everything and keep the cash for very long periods of time as well.
So if we have to, talk about numbers, again, I'm saying, we have spoken about stocks and we may talk about returns now, while we're ending this webinar. It's not to kind of, I would say, attract any investor, and every investor should do one's own research before investing into any equity product. But obviously, because there has been a lot of curiosity amongst people in the audience who are wanting to know what have been your return numbers, and if you could also share return plus maybe standard deviation beta of your portfolio over last 1, 2, 3 years, that will give some indication to investors out here in terms of your performance track record.
Yeah. So according to SEBI, we're not supposed to give any return guidance, but first mandate is to beat the index. Ours is the S&P BSE 500, so we want to beat it substantially, not by 2-3 percentage point. One is that. A second is that I don't know about others' expectations, but if I were an investor, I can just say about myself, what I would have returned, I would have been satisfied with. So I would look at what the fixed income is giving. Let us say the fixed deposit is giving 7 to 8%, but here I'm taking the risk of equities, so I need a higher return. So if I can get 3 to 4 times FD returns, I would be a very happy investor.
Be very happy investor even if I get 2 times, but 3 to 4 times is definitely going to be, one is going to be very happy for sure. Last question to you, Siddharth, what is the composition of your portfolio in terms of number of stocks?
See, right now we are just adding, but it will not be very concentrated ever. It will not be very diversified either. anywhere between 10 to 15 stocks would be the composition. It doesn't go lower than 10, it doesn't go higher than 15. But within that, the top 5 or 6 would take up most of the capital.
Sure. Thank you so much for your time today. You kind of shared on a very relevant topic, especially at this time where over last 18 months, investors have actually learned hard way that yes, valuations do matter. Many of us were talking about pharma, consumer businesses, IT businesses 18 months ago, and all of these businesses looked moated and kind of full of order books. And obviously they were trading at high valuations, but over last 18 months, they have given negative returns or zero returns. And that is where investors have started to learn again that yes, value investing does matter, and value investing is what remains in long term. So again, I thank you everyone for joining us today, and I have shared the link of book your appointments on the chat box. We want to always help investors make well informed investments, and we select fund manager as well as product through quality, risk, and consistency framework. So we are very selective in our approach. I am nowhere saying that Prudent Equity is a fund that we have selected for you. Neither I am saying that we have not selected it for you. It's basically dependent on your risk appetite and your time horizon. You book appointment with our experts, and we'll kind of rationalize this in every conversation that we do with you, and that's our style of working. Thank you so much once again, who have logged in today, and thank you, Siddharth, for taking your time.
Thank you, Kamal. Thank you so much.